Any analysis of viability and sustainability is sometimes limited incorrectly to just the finances of an organisation. This is generally because the money side of our operations is more easily measurable in dollar values, and there are generally accepted accounting principles and standards that we can work toward. And while we now recognise that money is only one of many input resources that drive viability and sustainability, it's still often the first element that our stakeholders look at to get a picture of our ability and stability in the short to medium term. Solvency is the organisation's ability to pay its debts as and when they fall due. If an organisation is not solvent, then viability and sustainability are not even a consideration until solvency is resumed. Solvency and cash flow are often interrelated, and the question of solvency is becoming a critical consideration of many organisations who are or will be transitioning from block funding, received in advance, to client-directed packages where payments for services will not be received until after the service is delivered or in arrears. Under this new model, we need to make sure that our organisations have enough cash to continue to pay our debts while we wait to deliver our services. We will discuss this further in a moment when we talk about our burn rate. However, in a final note about solvency, we must also remember that a director may incur personal penalties if the director knew or ought reasonably to have known that the company was insolvent and yet continued to trade. This may include financial responsibility for the debts incurred, and this is not covered by directors' and officers' insurance. An organisation is viable where, given normal service conditions, the organisation will produce sufficient inflow of resources to at least balance all the operating costs, strategic outflows, and forecasted risks required to achieve the strategic plans and expectations of stakeholders in the short to medium term. Viability is not an absolute assessment. It is generally expressed as being at a certain point currently or in the short to medium term under current or reasonably known conditions. The financial benchmark inherent in the definition is set as at least being able to evidence the ability to balance contractual income, such as grants and funding, with our operating and capital costs and risks. Viability is then sustainable where continuity in the planned balanced inflows and outflows is reasonably achievable in the longer term under changing conditions. If you can show that your organisation is viable for the next 5 years or more, then you are sustainable. Sounds easy, doesn't it? So, how can we find out if we are financially solvent, viable, and sustainable? The first step, we need to look at our financial statements. So the best place to start when looking at our financial statements is our profit and loss statement. Our profit and loss statement is the transactional records of what income we have received and what expenses we have paid over the last financial accounting period, be that 1 month, 3 months, or a whole financial year. The most important thing that our profit and loss statement can tell us is what our performance was like over the last accounting period in accordance with our budgets or forecasted performance. Are we meeting our budget expectations? Are we sure that our expenses are not consistently higher than we forecasted, or even more importantly, not consistently higher than the income we are receiving? Can we see any trends between changes in our income or changes in our expenses? And what does that mean for our overall operational budget? Most importantly as well is, do we need to review our budget? Because remember, our budget or our forecast is an arbitrary financial statement that we have created based on historical evidence of our organisations. As our organisations change, so too do our budgets and forecasts that we can receive over the coming 12 months. Another important opportunity to have a see through our profit and loss statement is the decreases of expenses due to changes in already incurred, or alternatively our increase in expenses, and how that affects our overall margins. When we look at our strategies for future change at the end of this session, we will actually see that margins is very important to the ongoing surplus of organisations. And a very wise woman told me in one of our workshops while I was away that there's no mission without margins. If we now look at the second profit and loss slide, we will see an example spreadsheet from XYZ organisation. Now this is not directly out of MYOB or QuickBooks, but it still gives us a very good indication of what the organisation is budgeting for in the future year, but more importantly, what were the actuals from the previous years so that we have comparative points. So in this particular spreadsheet, we have all of the different opportunities and all of the different income streams that we receive through grants and fundings, both on a Commonwealth and a state level. We have our actual figures for 2013, our actual figures for 2014, and our forecasted figures for 2015. We have further broken down those forecasted figures into quarterly income streams, so it gives us a little bit more of an understanding about our cash flow. We've grouped it into total income, but we have also then included all of our total expenditure. Now this is a very simplified model compared to all of the different expenditure lines that we would have in a normal accounting system, but it does give us a top line on the key expenses going out as well as our key income coming in. And if we have a look, in 2003 there was a surplus of $19,600. We had a surplus in 2014 of $66,830, and we have a forecasted surplus for 2015 of $100,750. They are all in the bottom line of the chart and indicated there as net surplus / deficit. So again, when looking at that profit and loss statement then, we would be looking toward the trends of income, what has gone up, what has gone down, what agreements or grants have increased, what agreements or grants have decreased, where are new income streams coming from, against our trends in expenses. Again, what expenses have gone up or down, what are the trends, and whether or not those trends change our forecast or budget for the next 12 months. It's an important aside here to understand the difference between a profit and loss statement and a cash flow statement. A cash flow statement not only includes our income and expenditure, but also includes any incomes or expenses in regards to capital income or servicing capital debt. So it supports our position of solvency and viability, but unlike the profit and loss statement, the cash flow also considers our capital. Our capital income could include bank overdrafts that we've drawn down and then reduced. Our capital expenses includes property on capital assets such as property and in some circumstances large vehicle expenses. It also considers our cash receivables, our grants, service charges, membership fees, donations, and the interest that we have gained on those monies, as well as our cash payables, salaries, wages, audit fees, consumables and direct services costs, and any interest that we may have received while holding those monies in our accounts for accounting periods. This is particularly looking at anything to do with PAYG wages, where we pay those on a quarterly, or any long-term payment fees that we are holding in special accounts for long service leave or holiday leave. The final document then that we look at is our balance sheet. And unlike our profit and loss statement that looks at the viability of our organisation, can we afford to keep operating, the balance sheet does now start to look at the sustainability of our organisation. What is the financial worth of our organisation on this day? So the first question we can have a look at when we look at the balance sheet is, are we solvent? Are our current assets greater than our current liabilities? Do we have the monies in hand to pay our debts as and when they fall due? It also does address the question of, are we viable? Could we continue to operate in the short to medium term if our funding stopped? And again, that looks at our current assets or our cash at hand. And it is very, very important to remember at this particular point that this cash in hand is our unrestricted cash, not that cash that has been paid by government grants or funding to deliver services that we are yet to deliver. Finally, it addresses the question of, are we sustainable? What is our equity? How much do we have left in the business after all of our liabilities are paid? So again, we have an example balance sheet here from XYZ organisation. And it looks at our current assets, our non-current assets, current liabilities and non-current liabilities. And for those that aren't accountants, it's really easy to remember the difference between current and non-current. Current is anything that we can turn into cash readily to pay our debt. Non-current is anything that would take longer to turn into cash but is still considered an asset of the organisation. And in most cases, this is property and vehicles. Similarly, for liabilities, current liabilities are the debts due to be paid within 30, 60 or 90 days versus the long-term liabilities, which are ones that we still need to save for but may not be payable in the short or medium term, but in the longer term, such as holiday leave and long service leave. The difference between all of our assets and our liability is the equity that we hold within the organisation. Now, this equity is different from our surplus because a surplus is the cash that we have in hand, whereas equity takes into account our long-term assets and our long-term liabilities as well. So it gives us a stronger position or understanding of where we would be in that longer term. The greater the equity we have in our organisation, in general, means the more sustainable our organisation would be. The critical piece of information we can derive from our profit and loss or cash flow statements, together with our balance sheet, is the current viability or burn rate of our organisation. Our burn rate is how long we can continue to operate without any further income to our organisation. If we now have a look at the next slide on burn rate, there are 3 very easy steps that we can take to calculate our burn rate. The first step is to calculate our cash position from our balance sheet, which is the current unrestricted assets that show in our balance sheet less our current liabilities. The second step is to calculate our average expenses from our profit and loss. So that can be our total annual expenses divided by 12 months to give us a monthly expense, or 52 weeks if we would like to get our average weekly expenses. Then the third step is calculating our burn rate, and this is just simply the current cash position calculated in step 1 divided by our average expenses calculated in step 2. This will give us how many months, or alternatively weeks, we can operate without any further income. Given the changing situation and any organisations that are changing from block funding in advance to client-directed funding in arrears or at the time of service delivery, we really should be hoping that our organisation holds approximately or up to 3 months cash in advance to be able to manage our operations through that transition period. If you're an organisation that has less than 3 months, one of the strategies you can start to employ now is strengthening that position for the future. We have worked with several organisations over the last 12 to 18 months to assist them in this, and it has worked very well in regards to slowly but surely strengthening their position from 1 month to 2 month to 3 months burn rate. Many organisations are starting to include their current burn rate into their financial reporting to the board. There are other financial ratios that are also very helpful in determining our current financial position and the potential impact versus profitability of our activities and programs. CSA has developed a financial reporting template for committees and boards that can be easily created from the information in our profit and loss and balance sheets. If we now have a look at this example spreadsheet, we can see that there is a lot of information we can gain from our income and expenditure or profit and loss sheets, balance sheets, and applying those to financial ratios. For example, underneath our income and expenditure, we can add notes to our accounts. So note 1, the total income for this accounting period was X amount of dollars against a budget of X amount of dollars, and this is a variance of Y. Note 2 is a breakdown of income by program or by funding body. Note 3, an explanation of the variances, if required. And note 4, forecast of income for the next accounting period. It goes on to then do exactly the same for our expenses. The total expenses for this accounting period was A versus a budget of B with a variance of C. Breakdown of expenses by program or funding, explanation of variances, forecast of expenses for the next accounting period versus budget, and the average monthly expenses year to date. If we then do a summary of the notes from our balance sheet, our current cash position, our current burn rate with an indicator showing less than 3 months, equal to 3 months, more than 3 months, comparison of this accounting period to the previous 2 periods, and notes of explanation if required, and any forecasted or changes that may be necessary due to changing in budgeting circumstances, if we know them. Now, from this information, we can also garner a broad range of financial ratios that are more popularly used in commercial models, but can be just as relevant to not-for-profit organisations. The first financial ratio is liquidity. Liquidity is simply the current ratio or current total assets divided by the total current liabilities. Now, in most cases, we would want at least $2 of assets for $1 of every liability, but in the not-for-profit world, this would be a rarity. In our circumstances, we would be much more happier looking at $1.30 of current assets for every dollar of liability, and this gives us a 30% margin which would be used to cover our overheads, fluctuations, changes in expenses, and being able to also manage any changes in regards to immediate or short-term expenses that we may not have forecasted for previously. Another financial ratio that we can work toward is our profitability financial ratio. Now, this is also known as a net margin benchmark, and it is calculated by simply dividing our surplus from a program or from the organisation as a whole by our income from that same program or organisation, and that gives us a percentage. For sustainability, we would be wanting at least a 7% profitability ratio across all of our programs. And this 7% is certainly an acceptable margin of profitability or surplus in regards to any government contract that we would have. If we had self-funded or user pay programs or other types of sustainable income, we would be looking more towards a profitability margin of up to 15%. And again, if we keep that income segregated as unrestricted funds against our income that we receive from grants and funding as restricted funds, we would not be in a position to be reporting that back as an overall surplus to the organisation, and thus keeping in our 7 to 10% surpluses that the government allows us. The third financial ratio that is very important and very helpful is our solvency ratio. That is our debt to asset ratio, or total liabilities divided by total assets. We actually want this to be less than 1 to 1. We need, if our total liabilities are greater than our total assets for more than one accounting period, the ongoing solvency of the organisation must be investigated. And certainly if you're a CEO or a financial manager discovering this, you would be reporting this immediately back to the board. So again, that is the ratio if it is less than 1:1. Overall, the Statement of Financial Position is an excellent cover sheet to be able to put in front of your board every time they meet, or alternatively on a quarterly basis to ensure and understand the financial position of the organisation. This gives surety to the board that they are meeting the areas of solvency, viability, and planning towards sustainability in regards to the financial position of the organisation. Another option is to include a statement of solvency, where the management sign off on the current solvency of the organisation each month. This does assist in the protection of directors, if only to bring the issue up each month for discussion. An example of a certificate of solvency is on the website.